So, just before I dive into all these fees that we're going to be talking about and different ways that you can make money as a multifamily syndicator, wanted to also introduce you to our group and myself. So our group is called the Multifamily Investor Nation, and we're a nationwide group growing over about 12,000 now. Coming up in September will be our first year anniversary of when I founded the Multifamily Investor Nation. It's been a great ride. There's been a lot of people we've been able to meet and connect with, and the group continues to grow and expand, and very, very happy and excited about that. We do have another summit coming up. You can go to mfinsummit.com. It's going to be for January 2020. And so it'd be January 16th, 17th, and 18th. It's a 3-day all online live conference that you can attend from the comfort of your own home. We also provide some additional networking opportunities virtually that you can be a part of and participate in. And I also want to encourage you to, if you're interested in investing with my syndication group passively, you can do that as well. The easy way to do that is just go to passiveinvesting.com. There's an investor form there that you can fill out and let us know that you're interested in that. And then you and I will jump on a phone call and we'll discuss your investment goals and see if our group is a good fit for you. So look forward to that. I also want to dive into some of these fees, right? So we're talking about how do you make money as a multifamily syndicator. So one of the first and most common fees are going to be your acquisition fees, right? And so this is where whenever you close on a property, not when you sell it, but when you're actually buying the property, you get what's called an acquisition fee. And so this acquisition fee is typically a percentage of the overall project cost or the overall purchase price of the property. And so that's usually anywhere between 1% to 5%. So the larger the deal, usually there's going to be a lower fee for those large deals, usually close to about 1% or 2%. And then some of your smaller deals will actually have a little bit of a higher fee because the costs are still the same. It takes the same amount of time, energy, and effort to close a small deal as it does a large deal. So typically, a lot of times the syndicators will charge a little bit of a higher percentage if it's a smaller deal. All right, and let's see. That fee is paid upon closing. So when you actually purchase that property and acquire it, that's usually when that fee is paid out, is upon closing. And then some syndication groups will decide to defer that until after they sell the property or until after all the initial capital has been returned to the investors and various things like that. It's not very common that that's done, but I have seen it structured that way. Most of the time, 99% of the time, I've seen the syndicators that are charging the acquisition fee having that paid upon closing. And then a lot of times the syndication groups will also need to get a secondary loan guarantor. So there'll be what's called a loan guarantor fee, which is paid to the key principal or the sponsor who is putting up their balance sheet. And that is usually going to be anywhere between 1/4 point to about 1/2 point. And sometimes it can be a little bit more. Sometimes it can be a little bit less. But it really just depends on that particular loan guarantor and what they're charging. So those are just kind of the two fees that I kind of lump into one, is like that acquisition and loan guarantor fee. And both of those are typically paid upon closing. The next fee here is going to be your asset management fee. So your asset management fee, this one's going to be based on a couple of things. There's a couple of things that can happen here. The asset management fee is going to be an ongoing fee that is paid to the group, the syndication group, to actually continue to manage this asset. And so there's two ways to structure this that you'll typically see. Typically, you'll see, I guess the most common would be that the percentage, which is usually anywhere between 1% to 3%, anywhere between 1% to 3% it's usually 1% to 3%, and it's usually based off of the overall income of the property, and that's paid out on a monthly basis. And that helps to continue to offset and pay for some of the costs that it takes to be able to hire some additional people and things like that to start to manage more effectively and efficiently your investment through the syndication group. And that's usually 1% to 3% of that overall income. Now, I have seen it charged a little bit differently. And this is why you have to be careful when you're looking at other projects and deals, is I've seen that charge be based off of the overall portfolio value. So you have to be careful there too, because that can get pretty expensive. And so sometimes if you'll see a lower asset management fee, like 1/4 point to maybe say 2 to 3/4 of a point, that'll usually be based off of the overall portfolio value, which is kind of similar to a financial advisor who's getting paid based on an overall, book value or whatever that they're managing, or asset management. And that asset management fee is based on the overall value of that. But typically and more commonly, you're going to see in syndications that is based off of the gross income off the property, and that's paid out on a monthly basis. That's going to be anywhere between 1% to 3%. The third one that we're going to talk about is what's called a disposition or a refinance fee. So I'm lumping both of these together because it's very similar but different. So a refinance fee, these ones, both the refinance and the disposition, are going to be anywhere between 1 to 3% of the overall refinance purchase amount, so or the disposition amount, the sale price amount. And so it's 1 to 3%. And the refinance fee is, say you close on the property this year, and then say 2 or 3 years. And once you've implemented your value plan, you are now going to be able to, or you have the potential or the opportunity to charge another fee called a refinance fee, where you're going to refinance that bridge debt, or possibly put a supplemental loan on a permanent agency debt and put on and charge an actual refinance fee to be managing that piece. That because there's a little bit of a lot of extra work when it goes into some of the extra paperwork and time involved. It can take up to 3 to 6 months to be able to process some of those refinances, as well as the exits as well. And so the refinance fee would be paid upon closing of the refinance loan or the supplemental loan. And that would be paid upon closing that particular loan. That would probably be in the middle of an actual investment. And at the end of the investment, when we actually sell the property, that's another opportunity to be able to charge that what's called a disposition fee. So you're actually selling the asset and disposing of it. So you're selling it and moving it on to the next person, and that takes a lot of extra work as well. And so that's why that extra fee is built in there as well. Then the fourth fee, that is which is part of the top 4 most common fees, is going to be that property management fee. Now, if you're vertically integrated, our group is not, so we do not have a property management arm to us. We actually do it. We actually have that property management done as a third party, so that we don't get paid this. But if you do want to vertically integrate, and I have seen some people do it successfully, I've also seen some people do it unsuccessfully. But you can, if you want to vertically integrate and do it yourself, you can charge a property management fee, which if it's on a smaller unit, you're looking at probably, if it's less than 100 units, you're looking at between about 5 to 7%, or as much as like 10 to 12%, depending on the size. So it can go down if you have a lot smaller asset, under 20 units or so, you're going to see that fee inch up a little bit, and it all is going to be based and dependent upon the market. And so there are lots of different property management options that are out there, and the ones that have the lower rate, that 3 to 5%, is usually the larger assets. We're actually currently underwriting a deal right now. Actually, I was about 1 to 2 minutes late of starting this webinar today because I was on a 1 hour virtual meeting via Zoom with my team, and we're currently underwriting a property, and it's over 200 units. So it's actually over 250 units. And so we're actually going to be able to get that fee down to about 2.5%. So it just depends on your relationship with your property management companies, how big your portfolio size is, and then also how big their portfolio size is in that market. Because most property management companies, when you're talking about these larger units, over 100 units, they're wanting to make about $60,000 to $70,000 a year in order to just break even with their expenses of having the regional manager there and that extra on-site and various logistical things and administrative expenses. So there is a certain number that they're trying to hit, and so you want to make sure that you can hit that number with them and that you build those strong relationships with those property management companies. All right, so those are the 4 most common fees that we're going to talk about. We talked about today. So if you have questions about those, go ahead and type those into the box now. I do see one question in here from Roy, and so I'll answer that one here in a second. If you have any further questions about those 4 most common fees that are charged, go ahead and type them into the Q&A box or the chat box. I'll be glad to answer them in either one of those. Usually we just use the Q&A box. It makes it easier for me to keep track of things. But Roy's question was about the disposition fee. Is that based on the sale price? And yes, the disposition fee is based on the sale price of the asset. So the difference might be is what's called when we talked about earlier, that first one, which is the acquisition fee. There are multiple ways to base the acquisition fee. And so you can base it off of the purchase price of the asset. You can base it off the purchase price of the asset plus the CapEx costs. You can also base it off what's called the overall transaction amount, or the gross transaction amount, the gross transaction total. And that's basically going to be your purchase price, your CapEx, as well as your closing costs on top of that. And so it can be based on that larger of those 2 or 3 ways to figure it out. So, but the disposition fee is based on the sale price of when you're actually selling that asset. All right, so I don't have any other questions coming in right now, so I'm going to go ahead and move on to the less common fees. But if you have questions about that as we move forward, you can certainly type those in there, and we'll answer them as we go throughout. All right, let's see here. So Praveen has a question here about how the acquisition fee works. If I have invested $100,000, will they take $3,000 up front and invest only $97,000? So I have seen that done before in some groups. It is not very common from what I've seen. Our group does not charge that up front like that. So if you invest $100,000 and we're raising, say, $12 million, you're going to maintain your equity position based on your $100,000, not on your $97,000, which would be your $100,000 investment minus the acquisition fee. So that's not necessarily how that works. So good question, but it does not usually dilute that $100,000 investment down to 97. You would stay in as a $100,000 investment, and your return calculations would be based on your initial investment, which would be $100,000. So you should still maintain that original $100,000 position. All right. So the next thing we're going to go over here is the less common fees that you can sometimes see. These are fees that I don't always recommend, and I would suggest you adding these very carefully. And when we talk about fees, when we're talking about the syndication fees, right now the market is very tight. So we're in the latter half of Q3 of 2019, and so it's a little bit tight, right? So we just had the Fed cut the rate for the first time last week since 2008. And so the market is getting very, very tight. Prices are going up. So the more fees you add, the harder it is going to be for you to be able to make some of these numbers pencil in properly and give the proper returns for your investors. So I'm an investor, as well as my two other partners in our syndication group. We are all three partners, and we all three invest alongside of our investors in each one of our projects because we're investors first. We want to be able to make returns off of our investors just like our investors do as well, and also have that alignment of interest. And so one of the things that we want to make sure we don't do is get too fee heavy, if you will. And some of the fees that we charge as our group, we've been told that, we charge too many fees, but you just have to be very, cognizant of those fees that you're charging and make sure that the fees you're charging are palatable for your investors, because if you're trying to raise money for a project and you have too many fees, sometimes your investors won't want to invest with you. And so you'll have to make sure that you modify that and change it for your investors. But if you have one or two investors that complain, it's probably not that big of a deal. But if you start to have a large majority of your investors starting to complain because your fees are too high, then you might want to rethink some of those fees. And then also some groups will make sure that there are certain markers in place before they even collect those fees and return targets. So make sure you have those listed out in there. And if you're investing in another project, when those fees are being paid, how they're taken, and if your investment is protected first. And what I mean by that is, like, if we go back to that disposition fee, our group doesn't get a disposition fee unless we return the initial capital to investors and they get their actual projected return. So we want to make sure we overachieve and overexceed our projections, and then we get paid that disposition fee. So it's obviously a capital stack in there when it comes to some of those fees and when you get paid those. Some groups will pay out all their fees first and then distribute, so you might actually get less than what you projected, but the syndication group would still get their money. So we feel like as investors, we want our investors as well as ourselves to get paid first from an investor standpoint, and then from the syndicator standpoint, if we've actually achieved and overperformed that property than what we projected, then we'll pay those out as well. So the four less common ones is going to be a brokerage commission. And this is if you are a real estate broker and you're going to be purchasing the asset, and it's going to be charging this to the seller, of course. So the seller is going to be charging this. So a lot of these multifamily acquisitions, what you'll find is that there's only a one-way broker. So it's usually only a broker that is representing the seller, and not a seller and the buyer. And so what'll happen is meaning, what I mean by that is you can bring in a buyer's broker, but the buyer has to pay that fee when it comes to some of these larger acquisitions. On some of the smaller assets, probably under 50 units, there might be some additional splitting, if you will, between different brokers. But, you're going to burn some bridges if you're a broker yourself. At least I feel like you would. If you go to another broker that has a listing and say, "Hey, I'm a broker, I want to buy it," and then you get your 3% or 2% or whatever it is for that broker, the buyer's broker side of bringing the deal to that seller. And what's going to happen is if that's a big name, multifamily broker in the area, and they're selling a lot of assets, they're not going to probably send you too many off-market deals, and they're not going to really want to work with you too much. And so you want to really build relationships with those people. And so even if you are a broker, my recommendation would be to, mention to that broker, yes, I'm a broker, but I'm not looking to get a commission split on this. I'm actually just looking to acquire this asset, and build that relationship with that broker and make your money off the actual syndication and not trying to broker that deal. The second one would be that's for when you're buying the asset. So the second less common one is brokering when you're trying to sell it. So it's a lot. It's highly encouraged to find a multifamily broker to sell your asset, because they have that large list, that large buyer pool and buyer list to be able to sell your asset and sell it quickly, and allowing them to be able to take that by the reins and selling it. And it also it actually looks better for your investors as well. So you're not making acquisition fees, asset management fees, and these disposition fees, and then all of a sudden you're getting a buyer broker fee and a seller broker fee. Kind of looks a little bit off when you start to do some of that kind of stuff. The third fee that we're going to talk about today on the less common fees is going to be a construction management fee. And what I mean by it being less common, so it's less common for a syndication group to charge that construction management fee. And that's usually about 5% is what that one's usually. But usually what you'll see is if you're vertically integrated, yes, you'll see the syndication groups charging that for the capital expenditure and the renovation plan. But the 5% is usually charged and managed by the property management company that you're using. So that property management company, whatever that capital expenditure amount is, they will charge a fee called a construction management fee for them to have their, staff contractor or third-party contractor to come in and oversee the renovation project. That's usually 5% of the overall renovation budget. So, and it's all based off of the agreement that you have with your property management company. And the fourth fee, and least or one of the least most common fees, is an accounting or tax fee that is time spent on bookkeeping and document preparation. And that can be anywhere between $30 to $50, sometimes $75 an hour for that accounting and tax fee. So that can be charged based off of usually is based off of the number of hours worked managing and preparing those documents. A lot of groups, though, will just lump that into the asset management fee, because that's where a lot of those expenses should be coming from, is that asset management fee, which are already being held. So, all right. So those are the four most common fees. We're talking about the acquisition fee, the asset management fee, the disposition or refinance fee, and then you also have that property management fee. Those are the four most common. And then the four least common are going to be the broker commission when you're buying the asset, the broker commission when you're selling the asset, and then your construction management fee, and then your accounting and your tax fees, which are based off of those hourly fees as well. So if you have any questions around those particular fees, please feel free to type them into the chat box, and I'll answer them as best I can. Where most syndicators are making their money is really not on a lot of these fees. Where a lot of where you should be as a syndicator making most of your money is when you actually perform the asset the way you projected and you're outperforming it. You're going to make it off of what is called the cash flow, or off of the actual promote. So not the cash flows, but the actual promote when you sell the asset. So when you sell that asset, you have that 70-30% or 80-20% spread where you're going to be able to split the entire project 80% to the investors or 70% to the investors, and then 30% to yourself as the sponsorship team. And so that 30% of that sponsorship team, when you sell that asset, that should be really where you're making most of your money, because that's where you should be overperforming on the projections and really trying to achieve those returns that you promised to your investors. I don't want to say promise, but you projected to your investors that you're going to try to get the property to. And so a lot of times there'll be some various hurdles where there'll be different at different points. There might be a different split in the fee in the actual membership ownership based on return projections. So make sure you watch out for some of those kind of things as well, based on some of those splits or waterfalls. But that's really where most of you guys as a syndicator should be making your money. And for those of you who are watching that are passive investors, that's one of the things I wanted you to keep in mind too, is that it takes a lot of energy and time and effort to put these projects together. Our syndication group will look at, 30, 40, 50 deals that, we will, look at, underwrite, tour before we get one that we're going to present to you. And so it's not just the time and energy effort for that one deal. It's for all the ones that we didn't get that we're trying to make sure that we are staying conservative, and we're watching the numbers, and we're, we're buying properties in blue chip markets that are going to be stable, even if there is, or when there is some form of a downturn or correction in the market coming up. All right. And so final thing here is that all the fees should be outlined and disclosed inside of the PPM, the private placement memorandum. And this is when you're doing a syndication type of offering. And so make sure that these are all listed there. You don't want to hide anything from your investors. You want to be very clear and disclose to them up front, so that there's nothing in the back end where they go, wait a minute, you didn't mention that fee to me. So make sure you have all those disclosed. All right. So next month, at the next month's Multifamily Investor Nation Summit, the Multifamily Investor Nation monthly meetup, which is going to be the first Monday of every month. This is going to be live, local, in person. You will have a local co-organizer in your area. And if you don't have one and you want to help us out, we provide the content for you and teach you based on that content. And then you go to your local meetup the next week and provide that to your local market. And you build your local authority and brand in your local area there. And so next month's topic is going to be on picking a multifamily market for investing. So we're going to be diving deep into that topic next month. So make sure you stay tuned for that, and you go register for your local meetup there. And if you want to participate and be one of our local co-organizers, shoot an email to Stacy, STACEY, at multifamilyinvestornation.com. So let me go through here and see what kind of questions we have, and we'll try to get through as many of these questions as possible. So it looks like here we have Bill asked a question: what is the typical investment position by the syndication principles, a percentage or dollar amount, or is it based on asset size? And I'm not really sure if you're asking on the sponsorship side, Bill, if you what the actual position they would have as far as the portion of that 30%, or how much of the equity that they're actually putting up front. So if it's going to be, how much money they're putting into the deal to align with the investors, or if it's how much they're getting split. But I'll answer kind of both questions. So the equity percentage is based on the roles that each one of the principals is going to be providing inside the group. And so it's a topic for a different webinar as far as how those fees are split up. But I will do a webinar soon on how those different fees split up. But as far as the equity is concerned, which yes, I see there, Bill, the equity up front is I recommend anywhere between 5 to 10% of the initial equity that's required. Sometimes you can see people do more. Sometimes you'll see people do less, or I've seen some groups that do 0. And so you just have to, see which groups you're working with. I like to see with my passive investments, because I do invest passively with other groups, that I want to see that the syndication group or the sponsor is actually aligning with me as an investor. And so I want to see them putting some skin in the game, if you will, and putting some equity in. So I like to see between about 5 to 10% of the initial equity being put in by the sponsors. And sometimes if it's a really large deal, I'm fine with maybe 100, 200,000, something like that. But if they have 2 or 3 sponsors, I want to see each sponsor putting in at least 6 figures into that project if we can. All right, let's see. Repeat the last 4. I think I got it. I think I repeated those earlier, but the last 4 are going to be the broker commission upon sale. These are the less common fees: the broker commissions upon sale, the broker commissions for selling the asset, and the broker commission. That first one is the broker commission for acquiring the asset. Broker commission for selling the asset. So those are the 2. The third one is the construction management fee, typically charged by the property management company. The number 4 is the accounting or tax fee, which is based on the hourly that it's going to cost to be able to manage some of the ongoing bookkeeping and document preparation for tax time and various things like that. All right, let's see. Is the 30% performance of the 70-30 split above and beyond the returns of the investor's equity position of, say, 5 to 10%? So I'm not really sure I understand that question either, Bill. The 30% is typically you have usually what, like for example, in our group, we'll have what's called an 8% preferred return. And so in order for us to get that 30% split in our group, the investors have to reach that 8% preferred return. Now, when we sell the asset, they have to receive their initial equity back before we get any of that 30%. So all the investors' initial equity goes back. So what we do is when we sell the asset, we pay the debt off, and then we pay the equity positions back to the investors, and then whatever is left, we split 70-30, 70% to the investors, 30% to the sponsorship team. And so that's typically how that is actually split up. And hopefully that was the question that you were answering there. You were asking there, Bill. Hopefully I answered that okay. Cool. Awesome. All right. So what should we be looking for when we receive distribution statements regarding the fees as a passive investor? Well, I think the biggest thing you have to understand is as a passive investor, you have to understand the fees that are being charged. And so, if the actual charges are going to be based off of, what are they going to be based off of? So you want to make sure that those are all listed out there. You also want to see, is the sponsorship team going to get paid their fees first? Or are the investors going to get paid first? So where does the investors lie in the capital stack? So in our group, we want to make sure our investors are paid out first. So we'll make sure that the investors are paid first for most of our fees, and then we get that. So if 1 month we can't pay an 8% preferred return because we do preferred returns and we do an 8% on ours, if we can't do that 1 month, then we don't have enough there to distribute an asset management fee. So we don't pay the asset management fee in our group and then see what's left to see if we can pay the 8% preferred return. We make sure we can hit the 8% preferred return to the investors. And then if there's leftovers, then we'll take that asset management fee, which when we do our projections and our underwriting, we only get into deals and projects where we can have enough there that we can all share in some of those cash flows off that asset. Our group only acquires Class B assets and stabilized blue chip companies. Blue chip areas that have blue chip companies surrounding the market that creates that stabilization. We want stabilized properties. So we want above 90% occupancy so that we can make sure we have an asset that is a good quality asset that'll continue to perform while we're holding on to it. So good question there. If you have any questions further about that, Praveen, glad to be able to help you out. Feel free to shoot me an email, shoot me a message. Any of the emails you get, you can always reply to those, and it usually comes to me, and I can be able to help you out in any way I can. All right, so the next question here is, so the 70-30 equity split or whatever split applies only at project disposition, or does it apply to monthly income as well? So typically what happens, and every group's just a little bit different on how they handle this, Norris, but it doesn't always happen just at sale. So the way our group does it, with our group, which is called passiveinvesting.com, the way our group does it is we'll make sure the investors get an 8% preferred return, and we pay that out monthly. And then at the end of the first year, and even after the second, third, and fourth year, we'll see what are the additional cash flows over and above that 8% that is left that we can distribute over and above that 8%. And so usually once a year, we'll look at the cash flows and see where is the cash flows above 8%, and then we'll give 70% of that to the investors, 30% of it to the sponsorship team. That's usually how that split occurs. It's just that when you dispose of a property, that's when you're going to get the largest share of it and the largest piece of it as a syndicator, because that's where that 30% is going to come in. And you're talking about, getting a, $3 or $4 million bump on the sale proceeds. You're going to get that split after you've returned the equity back to investors. You could get that 30% of that larger piece instead of just some of these smaller fees that are being charged for these various projects. So some groups though do pay that out on a monthly basis, and some groups don't have preferred returns. So a lot of times you have to look at that and see. Like I like to see preferred returns. I want to make sure that I'm a preferred in that capital stack, and I'm going to get paid first before the sponsorship team does. That's just one of my preferences. And so, but some groups don't have a preferred return, and so they'll just every month look at the cash flows and leave some of the money in the account for, obviously for operations, but then give 70% to the investors and 30% to the sponsorship team, no matter where the returns are. And so I like to have a little more protection with my investment, which is why we do that with our group as well, because one, I'm an investor first. And I also want to make sure our investors are protected, because I want our goal for our group to be that we don't want just an investor to be in just one deal. We want our investors to continue to invest with us long-term, and we want to make sure we take very good care of our investors. So we're going to make sure that we provide those preferred returns, even if it's not popular. We want to make sure we do that because it puts our investors in a better position, and we know we'll be able to stand out as a syndication group like that as well. All right, let's see. Any waterfall on cash on cash? So it's there are some groups that will do it based on the cash on cash. Typically, the waterfall structures are based off of the IRR, the internal rate of return, and that's usually only going to occur when you sell the asset, unless you're holding it for longer than 10 years or so. But for us, we typically do it all based off of an IRR, and we usually only have a secondary hurdle. So the first hurdle is obviously the 8% preferred return, where we then get 70-30, and then after that 8% preferred return, most of our projections right now are anywhere between about 15 to 18% IRR. So right now our group is charging it's doing a secondary hurdle based off of the IRR calculation on exit. And so if we achieve at least an 18% or higher an 18% or higher internal rate of return, our equity position splits from 70-30 to 50-50, but it's stair-stepped, meaning that from 8% to 18%, it's still 70-30. Then anything over and above 18% would be split 50-50. So it just incentivizes the sponsorship team to continue to outperform the property. All right, next question here is, if you miss PRR 8%, the preferred return 8% 1 month to your investors, do you roll it over into the next month or reset? If rolled over, do you add interest too? So there's not usually an interest that's added on top of that, but we do have what's called a cumulative preferred return. So we typically do it based on the year. So it's an annual preferred return. And so if we, for some reason, 1 year can only return, say, 6%, then the next year, yes, it is what's called a cumulative preferred return. The next year, the preferred return goes to 10%. And so, yes, we do that. Some groups do not. They do what's called a non-cumulative. So if they only hit 4% 1 year, then the next year still just resets back to 8%. So they don't always just add that back on. So that's another thing as a passive investor you want to make sure that you're looking at too. It's a good question there, Ryan. Next question here, what was the acquisition fee percentage in the first set of fees? So the acquisition fee is going to be based off of a couple of different areas. It's going to be the purchase price, it could be the purchase price plus CapEx, or it could be the purchase price plus CapEx plus the closing costs, which would be that gross transaction total or the gross transaction amount. And that's usually anywhere between 1 to 3% on a large deal, which is over 100 units, or it could be lower, or it could be higher than that, 3 to 5% if it's on a smaller deal. Just depends on the various projects. So our group has actually done 2 smaller deals where we've charged about 3.5% to 4% on those ones. And then on some of the larger deals, we typically are only charging about 2%. So right in line there with most of the other syndication groups and charging about that 2%. So it's usually anywhere between about 1 to 5%, depending on the size of the asset. And it also could be dependent upon the size of the lift on the asset as well. All right. Well, great. Let's see. Paka has a question about what is vertically integrated. So when I say vertical integration, it's basically meaning, you have a property management company, you have the syndication arm, where it's the investment group, and then you might even have, say, an insurance brokerage firm or a capital firm. And so you're vertically integrating, meaning that you're stacking on top of your syndication group additional services and providers that can be ancillary benefits to you. So, whether it be a construction team or a property management company, various things like that. That's what we call that vertical integration. So good question there. All right. Sorry, I missed the beginning of the webinar with the description of fees. Just wondering if there will be a recording. Yes, we will be recording this webinar. It's being recorded right now. So we will be sending that out to those of you who registered for this webinar. So there are no other questions that are coming in. Thank you guys so much for being here and attending the webinar. Looking forward to seeing you guys at one of the local meetups soon. So if you want to get some more information about the local meetups, you can go to multifamilyinvestornation.com. There's a little icon there with an M for meetup. You can click on that. It will bring you to our meetup.com platform, where right now we have 53 meetups across the country. Just added 3 more last month and are continually growing. We have a little over about 8,000 people now part of that, but we have about 12 to 13,000 now part of the full Multifamily Investor Nation group. Make sure you join us on our closed Facebook group. So I'm going to go ahead and post this on here so that you can come join us. at the Multifamily Investor Nation closed Facebook group, because at this group is where we like to try to continue the conversation that we start here in the group. So, or here on these webinars. So I'm going to go ahead and type into your chat box here the website, so you can go and join that. Just click on that link there, and you do have to apply to join on it because it is a closed group, but I will review that and get you started there. And also, we would encourage you to go and subscribe to our podcast. So you can go to your iTunes platform, just search for podcast, just the purple icon on your phone, and type in Multifamily Investor Nation, and you can subscribe to it. We interview operators from around the country that are closing deals. In order to be on our podcast, you have to have closed a deal within the last 12 months. So if you have closed a deal in the last 12 months, whether you've sold it or whether you've acquired it, and it has to be more than 5 units, then you can email us at Stacy@multifamilyinvestornation.com. That's my assistant, and she'll get you scheduled to be recorded for our podcast. And we talk about all the ins and outs of how you found that deal, how you're able to work with the seller and the broker and the attorneys and the lenders and your investors, and go really deep and get really granular in those podcasts. So I would highly encourage you, if you're a passive investor, if you're a full-time, syndicator, go subscribe to that podcast. You'll find a lot of value from it. I find a lot of value from it as the actual moderator in it and the interviewer, because I like to dive deep and challenge our guests that are coming on about their plan and how it worked and how it's going to work. And so make sure you do that. You go subscribe, and also help me out and help us get the word out for that podcast and subscribing to the podcast. So you can subscribe to it and then also rate and review it, and it helps us get it up. I think the last time I checked, we had like 62 reviews or ratings on it. So we'd like to get that up to about 100 if we can. So if you can help us out, go to there, subscribe to it. You can also find it on Stitcher, Spotify, and various places like that too. So thank you guys so much. Make sure you keep us on your whitelist for your emails, so you get our next webinar that'll be coming up next week. I'll be sending that out probably later today or first part of next week, so you can register for that. So thank you guys so much for being here. Looking forward to seeing you at the next Multifamily Investor Nation webinar.